This is Money in Motion video blog. Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins. On this last day before Christmas, I wanted to speak to you about some things that I'm thinking about and things I'm watching that carry us into 2014. Specifically, I want to talk about three things today. I want to talk about the change in quantitative easing by the Fed. I want to talk about how our three indicators are doing. And last and not at least important is what happened with the budget deal. So let's get started. Quantitative easing. The Fed announced that at the last meeting of the year that they were going to reduce their purchases by $10 billion a month from $85 billion to $75 billion, combination of U.S. government securities and mortgage-backed securities. This was all done in an effort to drive interest rates down to expand the economy. I found it interesting that the chairman in his last meeting as chairman would make such a significant policy change, but it is what it is. So we have a situation where the Fed is starting to ease, but the markets didn't react. The stock markets reacted very favorably, but the bond market basically was unchanged across all maturities. The yield on the 30-day and 90-day paper was about 6 basis points before the announcement, and that's where it is now. The yield on the 30-year bond was about 3.75 to 3.8. It's around 3.82 to 3.85. With interest rates unchanged as a result of the Fed action, I think the market's going to want to see more cutting before we see any significant move in interest rates. Now keep in mind, when the Fed came out of the market, meaning they stopped their purchases by $10 billion a month, somebody else has to make up those purchases, and that's the private sector and investors. And they want to make sure that they get paid a reasonable amount. So I think one of the vulnerabilities to the equity markets is the bond market, especially if the yield on the 30-year Treasury would approach 4.25%. With 4.25% yield on the long Treasury, it begins to make long bonds look very attractive to common stock, especially index of the S&P 500, with the yield probably less than half of that. So that was one of the three legs in the things that we're looking at. So interest rates basically relatively unchanged. It is possible that after the first of the year, new Fed chairman, there starts the discussion about what she's going to do. There's a possibility that the long end of the bond market could approach 4.25. If we get to 4.25, I would expect to see some selling pressure in the stock markets. Now going on to the second leg of our three-legged stool, that the price of gold. I said in my last video blog that I thought that gold could reach $11.50 an ounce. Just a few days ago it hit $11.83. It's still trading under $1,200. I still think it's possible to trade at $11.50, perhaps even lower. So we'll keep our eye on gold. And the last is the price of crude oil. Price of crude oil is trading about $1.50 above where it was when we started watching it. It's under $100. It's trading between 97 and 99. It has not broken out. It hasn't collapsed. It's staying in a relatively stable trading range, and I expect it to stay in that range for some period of time. So the indicators that we're watching, Treasury yields, gold, and crude oil, do not indicate, one, that we have any significant inflation on the horizon, and two, nor do we have any significant real GDP growth in the economy real soon. We'll continue to watch those and report on those after the first of the year. So the last thing I want to talk about is the budget deal. I was amazed when the two chairmen came together and decided that they had a bipartisan compromise bill on the budget that avoided the shutdown of the government. And as I studied the bill, one of the provisions that was not in the bill, was specifically excluded from the bill, was the extension of long-term unemployment benefits. And as I looked at that, I thought, my God, this can't be true. The Democrats are not saying a word. No senator, no congressman said a word during the debate about the fact that there were no continuation of long-term unemployment benefits for 1.5 million people. So as I began to think about that, I began to wonder, why would the Democrats pass a spending bill that had no continuation of long-term unemployment benefits for 1.4 million people? And then it came to me. After they pass the bill and get everything they wanted in the previous bill, there will be a new bill that will be introduced on a standalone basis sometime between now and the end of the year or the first week of the year to continue benefits. And the cost of those benefits would eat into a significant amount of the savings. They are basically, in my opinion, setting up the Republicans for a fall, because they'll propose the legislation. The Democrats will put the ball in the Republicans' court, and they're going to say to the public, the Republicans are not going to support the continuation of benefits. They want people to starve and go hungry. So they're put the Republicans in a corner. The Republicans are going to cry foul because they didn't do anything in the budget bill about unemployment. And the Republicans were duped by the Democrats. And I think what will happen is all the money and the savings and the work that was supposedly in the budget deal will basically disappear when we add long-term unemployment benefits. I seriously doubt there will be an opportunity until we get one-party control of both houses, whether it's Democrat or Republicans, whether we'll ever address the unemployment issue in this country. If the Republicans were to gain the Senate and continue their majority in the House next year, very possibly we'll make certain serious decisions. So, 2014, I hope, is a year of opportunity for you and for me. I think there's a lot of interesting things could happen in 2014 on both the political standpoint and the market standpoint. And it's my job to look after them to make sure that your portfolios are as well positioned as possible. I think there's a possibility we could see some movement up in interest rates towards the middle part of the year as we come into the congressional elections. And I think the economy is going to slow again, where our GDP will probably be under 3%. So have a wonderful holiday season. Merry Christmas and Happy New Year to you and to your family. And we'll talk again next year. This is Dan Perkins. Thanks for watching.